The genesis of power. To understand the immense power of the modern central bank, we must go back to its origins. Central banks did not begin as guardians of economic stability. They were primarily created to serve the urgent needs of the state, most often to finance war. The first institutions recognized as central banks, like Sweden's Riksbank and the Bank of England, were chartered as joint stock companies with a key purpose: to lend money to the government and manage its debt. Their original mandate was not to control inflation or unemployment, but to serve as an engine for public finance. They were part of the machinery of state power, securing its survival in times of conflict. This established a foundational relationship where monetary authority, the power to create money, was intimately tied to the fiscal needs, the spending and borrowing of the government. The guardrails and the first major failure. For centuries, this power was constrained by the gold standard, which tied the value of currency to a physical commodity and limited money creation. However, the 20th century began to test these limits severely. The defining early failure came with the Great Depression of the 1930s. The U.S. Federal Reserve, adhering to a flawed economic doctrine, failed in its critical role as a lender of last resort during a series of banking panics. The resulting collapse of the money supply deepened the economic catastrophe, demonstrating for the first time on a massive scale that central bank inaction could be as devastating as its actions. This disaster was a stark lesson that the old rules were insufficient for modern crises, setting the stage for a profound expansion of the central bank's responsibilities and tools. The bargain of independence following World War II, and after experiencing the great inflation of the 1970s, a new consensus emerged. Politicians, chasing short-term popularity, proved too willing to overstimulate the economy, leading to runaway prices. The solution was central bank independence ***. Society made a deliberate bargain. Elected officials would grant central banks, like the Federal Reserve and the European Central Bank, operational autonomy to set interest rates free from direct political interference. In return, these institutions were given a clear, singular mandate to ensure price stability. This model of the independent technocratic central bank became the global gold standard, credited with decades of low inflation and economic growth. It was a trade of direct democratic oversight for promised economic stability, the tool that changed everything. This independence was tested to its breaking point during the 2008 global financial crisis. With interest rates already near zero, central banks ran out of conventional tools. Their response was to deploy an extraordinary new weapon, quantitative easing, QE, ***. Essentially, central banks like the Federal Reserve and the Bank of England created new digital money to buy trillions of dollars in government bonds and other assets from the market. This unconventional policy did more than just lower interest rates. It fundamentally changed the central bank's role in the economy. Their balance sheets, the ledger of their assets and liabilities, ballooned to unprecedented sizes, turning them into the dominant player in financial markets. The institution tasked with guarding the currency had become its largest manufacturer, intertwining its fate with the fate of financial markets and government debt as never before. The ultimate test and a new threat. The ultimate stress test arrived with the COVID-19 pandemic. Governments worldwide launched massive fiscal stimulus programs, and central banks responded with even more aggressive asset purchases, effectively financing this spending. This fusion of monetary and fiscal policy successfully averted a depression, but unleashed a surge of inflation. To combat it, central banks have been forced to raise interest rates aggressively. This action exposes the new central vulnerability, historically high levels of government debt. Higher rates dramatically increase the cost of servicing this debt. This creates immense political pressure on central banks to cut rates prematurely to ease the government's financial burden, even if inflation remains a threat. This condition where fiscal needs dictate monetary policies known as fiscal dominance The core conflict. Fiscal dominance represents the central conflict of our economic era. It is the point where the foundational bargain of independence collides with political reality. When a government's debt burden becomes unsustainable, the central bank faces an impossible choice. Continue fighting inflation by keeping rates high and risk triggering a fiscal crisis, or abandon? Its price stability mandate to keep the government solvent by keeping financing costs low. History and recent global examples are clear. When fiscal dominance takes hold, high and destabilizing inflation is almost always the result. The power painstakingly granted to central banks to protect the economy is turned against its purpose, used instead to enable fiscal profligacy. The guardian becomes an enabler. The mirror of society and the path ahead. The story of central banking power is not a simple tale of a technocratic coup. It is a reflection of deeper societal choices. We outsource the management of our most difficult economic contradictions, balancing growth, inflation, and debt, to independent experts because our political systems repeatedly proved incapable of making the hard, long-term choices themselves. The awesome power of the modern central bank is a mirror held up to our collective short-termism and addiction to debt-financed spending. The path forward is uncertain. One road leads to a world of permanent monetary activism, where central banks are permanently subservient to fiscal needs. Another requires a painful, politically arduous return of fiscal responsibility. The age of the purely technical, apolitical central bank is over. The question that remains is not whether central banks are powerful, but in whose interests and for how long that power will ultimately be exercised.